nekauna na gathabai.
Yes, good afternoon. Can you confirm that you can hear me? Please confirm that you can hear me, please. Please confirm in the public chat forum that you can hear me clearly. So, welcome back. It happened, we had a week break of 2 weeks. So today I want us to take a very few minutes. I believe the notes on financial institutions and intermediary, I believe you have been having them for the last 2 or so weeks. And because I wanted us to take very few minutes, and if it is even possible, if you have gone through the notes, because I wanted to share the resources of our next topic that is now a mathematical topic, and I had prepared some videos, and I wanted you to download those videos and you make some short notes, because in those videos I've tried to explain everything, and then before we meet next week, at least you'll be somewhere. So, yes, please mute your mic. Please mute your mic so that you can be together. So if you have those notes with you, please let me know if you have already downloaded those notes. I believe you have. You have been having them for the last 2 weeks on financial institutions and the market and intermediaries. So in this topic, mostly is all about the financial institution that we know. When you talk about a financial system of a country, we have the various financial institutions that are involved in that financial system. Mostly we know about the Central Bank of Kenya. We know the commercial banks. Commercial banks are the normal banks that we know, the Equity, KCB, etc. We have insurance companies. I believe you know the insurance companies. We have now the microfinance institutions like SACCOs, etc. So when you talk about financial institutions and intermediaries, there are things that we interact with them. in our day-to-day lives. So in this topic, mostly we need to understand at least functions of each financial institutions. For example, can you be able to explain functions of commercial banks? Can you be able to explain functions of central bank? At least some functions of insurance companies. But the major financial institutions that they need to understand is a central bank, and then we have the commercial banks. They are the main players. And then the microfinance institution, in our case, because of the circles. Circles nowadays are very common. So mostly I need to understand at least you can be able to note some point on at least you know the meaning of the financial institutions. At least you can be able to explain some functions. So we are told there financial institutions serve as intermediaries by channeling the savings of individuals, businesses, and governments into loans or investments. If you just observe how a commercial bank operates, a commercial banks, how do they even make money? How do they operate? Or even the circles. If you have money, you go and deposit in those financial institutions, in those commercial banks. They use that money to provide loans to those people who need money. So it's a form of intermediary. Commercial bank is a form of an intermediary between those people who have money and those people who need money. So you have your own cash, you go and deposit into the commercial bank. Then another person needs to make an investment. He or she need cash. He or she is going to go to the commercial bank and borrow. So financial institutions are just intermediaries, savings to those people who are borrowing. So that's why we are told they are the major players in the financial marketplace, and they often serve as the main source of funds for business, especially they are the commercial banks or even the circles. So some financial institutions accept customer savings deposits, like now the normal banks. And Zipporah, please mute your mic, Zipporah. And lend this money to other customers or to firms. So just note that financial institutions, as we know them, they are just intermediaries. Intermediaries for what? Those people who have money and now those people who need money. Savers to borrowers, as simple as that. Then you have a subheading there, key customers of financial institutions, and the key customers are everyone. It can be individuals, they can be businesses, and even government, because even government borrow internally. When we say internal borrowing, that is in economics, mostly they borrow from commercial banks. So key customers will be all the way we normally know. It can be an individual, it can be a business, or even the government. Then after that, we go to the other section. So that is just explaining more about who those individuals, business, and government. Nothing should be complicated there. The major player here, commercial banks. So commercial bank is is a major player when it comes to financial system, and we are told that commercial banks accumulate deposits from savers and use the proceeds to provide credit to firms, individuals, and government agencies. Normally, that is how a bank make money. You go and deposit money in their bank or in the account that you have opened with that bank. Now they are going to use that money now to lend to other people. Now, when they lend to other people, they earn an interest. That is how they make money. So therefore, they serve investors who wish to invest funds in the form of deposits. We are told that commercial banks use the deposit funds to provide commercial loans to various sectors of the economy. It can be individuals through personal loans, or even businesses, or any other, or even the government. So commercial banks just try to understand it's all about accepting deposits and providing loans. As simple as that, from savers to borrowers. So our interest mostly should be now at least, can you be able to explain some functions of commercial bank? So can you be able to explain some functions of commercial banks? That's why we have the role of commercial banks. So we are told that commercial banks play several roles as financial intermediaries. First, They package the deposit received from investors into loans. That is a major role of any commercial bank because they have deposits from different people, from different businesses, even deposits from government institutions. Now they use that money now to provide loans to individuals, firms, and even government. So that is the first role, the major role that they play, repackaging deposits into loans, as simple as that. Now the second, if you go down there, we have the second role there. We are told that commercial banks employ credit analysts who have the ability to assess creditworthiness of firms that wish to borrow funds. You are going to realize that before you can get a loan from a bank, you need to talk to an agent of that bank. The function or the role of that agent is just to assess and analyze. Can you be able to pay back the loan that you're going to borrow? So that's why they request things like a payslip. They request issues like maybe profit of that business. So they have a very critical role when it comes to assessing the creditworthiness of individuals and firms. Because not everyone who goes to bank can be given a loan. We need to check the creditworthiness of that person or that business or that firm. What is the history? Remember when you borrow, I know nowadays people borrow money from many sources. We have the Tara, I don't know, the Mshwari. Be careful when you're borrowing such money from such applications or apps. Because when you fail to pay back even the 500, the 1,000, nowadays we have an institution that is referred to as a CRB, Credit Rating Bureau. If you fail to pay even your 500, after some time they can report it to that institution, and that will affect you in future when you want to take a loan. So before they can give you a loan, they first check your history, mostly through CRB. Maybe to check whether you have a history of not paying back loans. If you have that history, they may decide not to give you that loan, or if they give you that loan, they are going to charge you a very high interest rate. So always be careful when you're borrowing money from such applications. Just borrow something that you can be able to return. Right now, it may not affect you. They may not even be able to reach you. But in future, when you need money, because I can promise you, in future you are going to need money somewhere. You need to borrow a loan. Maybe in future you need your own home. You need a loan for a business. You cannot avoid taking a loan moving forward. So be careful when you're borrowing from such applications. Just try to pay back, if possible, to avoid a negative rating in CRB. So that's why that is a very critical role that they play because that can affect a person's future borrowing. Then the third one we are told commercial banks have so much money today that they can diversify loans across several borrowers. In this way, commercial banks increase their ability to absorb individual defaulted loans by reducing the risk that a substantial portion of the loan portfolio will default. Because remember, a bank receives a lot of deposits from different individuals from different businesses, and they can lend to different sectors. Remember, in an economy, this should be in economics, we have different sectors. We have manufacturing sector, we have retail sector, we have the wholesale sector, we have so many sectors, education sector, we have now have the health sector. When commercial banks are lending, they don't lend to one sector because one sector can be very risky. For example, what is happening now with the pandemic, we know education sector has been affected, sector has been affected. You can imagine as a commercial bank, you had provided loans. All your loans were provided to tourism sector and education sector. Most likely, that bank now is being affected. So they diversify the loans across several sectors in the economy, if not all, so that in case one sector is faced with some problems, then at least the bank is safe. You cannot risk investing all your loans in one sector. Now, tourism sector is very much affected because of coronavirus. Please, please mute your mic. Please mute your mic when you are joining. Please mute your mic. So I was saying a bank cannot risk investing or providing loans to one sector to avoid the risk that can come across in case that sector is affected. So mostly those are the major functions. Diversifying loans, repackaging to loans. But now we have other functions that you know. We have other functions that you know. For example, we have the fourth one there. Some commercial banks have recently been authorized to serve as financial intermediaries by placing the securities that are issued by firms. If you go to any bank, you're going to find that they can buy and they can sell securities. Securities are issues like shares. If you want to buy maybe a share or even foreign exchange, if you want to exchange your US dollars with Kenya shillings, commercial banks can mostly nowadays they do that function. But remember, or as you are going to note, that is a function of central bank. Only that they have at least allowed commercial banks to do that on their behalf. When you go and sell now your dollars or you want dollars, you have your Kenya shillings in commercial banks, they are doing that on behalf of central bank. But now we have other functions summarized down there. We have other functions that we know as we know them, that they provide a safe deposit for money and other variables. That is what we normally know. If you have your money, you can go and deposit in the bank. Even other variables, if you have your gold necklaces, for example, silver necklaces, people deposit such in commercial banks. They lend money to borrowers. That is a function that we know. If you need money, you can go and borrow from a commercial bank. They provide safe and non-inflationary means for debt settlement through the use of checks. In that, no cash actually handled. You can imagine you are dealing with a business that is paid millions, for example, per week or even per day. It can be very risky to carry cash in millions. So the safe means is using check. A check can only be authorized by one person, and the person who is given that check is only the person who can go and withdraw the money. So check is a safe means of settling debt. So instead of carrying cash everywhere, you just need a check and everything will be okay and it will be safe. Then another one is they act as agents of the central bank. That is what I was saying, that commercial banks act as agents of central bank in dealings involving foreign exchange. So the foreign exchange transaction that you see in banks, they do that on behalf of central bank. And another one is they offer management advisory services, especially to enterprises which borrow from them. When you borrow money from a commercial bank, most likely they are going to be very much interested. You want to do what with your money. So they listen very carefully, and in case they have some doubt, they can give you some advice, or they can withdraw or fail to provide that loan. So they offer that advisory services to those people who are borrowing from them. So at least you can be able to explain some functions of commercial banks as we know them. Then we have some other minor institutions. We have the mutual fund there. A mutual fund, we are told it is a professional managed type of collective scheme that pulls money from many investors and invested in stock and other securities. So mostly when it comes to mutual funds, it is whereby now professionals or a group of people, they come together, they put money together, then they buy shares and other securities in stock exchange markets. They can even buy treasury bills, they can buy treasury bonds, buying of shares of different companies, etc. But you will find that most of those mutual funds, they end up being the normal banks as we know them. So they can start as just as a group, a small group of people coming together, pouring money together, buying shares, buying other securities in stock exchange market, but they end up becoming banks, the commercial banks as we know them. So we are told that this happens when a large number of people give their money to professionals to manage and invest with the aim of achieving a return and in accordance with the objective of the fund. So bring money, give that money to people who know, or financial analysts, people who know how to deal with money. They invest that money for a return, as simple as that. But so some of the mutual funds that are known mostly in Kenya, or they were there in Kenya, mostly the British America, we know it, Stanbic, money market fund, but you find that most of these mutual funds, they ended up being banks, the normal banks that we know, or the mutual. Most of them now are normal banks that we know, but they started by people coming together and putting money and investing that money for a return. So now let's go to the next one. Wait a minute. So if you open now we are together, if you can check the next one, unit trust, there is no actual difference between unit trust and the mutual fund. In both, people coming together, putting money together, invest in that money with an objective of a return. So I cannot be able to differentiate between the two. Mostly when you talk about unit trust and mutual fund, you are talking about the same thing. Then we have the next one, employee share ownership plan. I'm getting lost. My system is hanging a bit. That's why I'm stopping at a point. So employee share ownership plan, we are told that an employee share ownership plan is simply an option by the employees of a company to buy shares of that company. Remember we talked about, I think in topic 2, the different types of shares, ordinary shares and preference shares. So this is just an option given by the company to employees. You are told that because you are employees of this company, we are giving you an option to buy shares of this company at mostly at a price that is lower than the market price. So mostly they are going to issue those shares at a price that is lower than the market price, so that they can encourage employees even to be more effective, because they know when employees have shares of that company, most likely they are going to be motivated to even work hard. So because they know at the end of the day they belong or they own that company. So we are told that the company normally has the right to determine the number of shares the employee gets, which employees get them, and the ownership is actually transferred. So mostly, in this case, mostly you find that top management are the one who are given these types of shares. They are the one who are given these types of shares to encourage management to be more effective, to be more innovative, so that if the company, so that they know when the company makes a profit, they benefit as a result of dividends. So mostly it is given to top management, not all employees. So you just need to understand that mostly nothing much there that need to be understood when it comes to mutual fund, unit trust, and EOSOP, but at least to have an idea what they mean. So we have the benefit of investing in collective investment schemes, because we have said they are collective investment schemes because they are people coming together and putting money and investing with an expectation of a return. So we have the benefit of diversification, because now as a person, as an individual, as an investor, when you diversify into different securities, you can buy shares, you can buy treasury bills, you can buy treasury bonds, you expect a return even if one sector or one area collapses. So we have the liquidity, there is ease in selling and buying the unit compared with investing directly, continuous professional management. Mostly those funds are controlled by professionals, access to a broader array of assets you can, or securities. You have so many securities that you can buy in Nairobi for example, in Nairobi Stock Exchange. Not only the shares, we have treasury bills, we have treasury bonds, we have commercial papers. There are so many that you can be able to buy, but unless you are talking to a professional, you may not be able even to understand how they operate. So when you come together and you let that fund be managed by professionals, you can be able to access a broader array of those assets. Convenience, record keeping, and administration because it is managed by professionals. Scope for good return, mostly because those professionals know those markets. You, in most cases, you have diversified your investment. Umenunua share, umenunua bills, umenunua bonds. You are expecting at least a good return. Then you have some tax benefits. When you get used to investing in a stock exchange, we have some tax benefits that you can get from those investments. Then let's now go to the next financial institution that is very common, insurance companies. And just need to understand that what are the insurance companies? Insurance companies are just a person who, or it's just that we can say it's a person, an artificial person, who now just come and tell you there is a likelihood that you are going to get a risk because of this and this, and I can stand or I can be here and stand on your behalf in case that risk arises. So insurance company is a person who come and take the risk that may arise in future as a result of it. So that way we are told they provide insurance for their customers, including life insurance, property and liability insurance, and health insurance. If you try to imagine how an insurance company operates, so they are just telling you, pay us little money, little in quote, pay us maybe 3,000, 1,500 per month per year. In case there is fire within your premises, we are going to pay for that. In case there is an accident of maybe your motor vehicle, we are going to pay for that. So insurance company is a risk taker. Is a risk taker, but they mostly they have done their own calculations, and they know even if all people are to claim, they were to claim because of the various risks that have already been actualized, there is no way they can go or they can get a loss. And there are so many rules and regulations that you need to follow that they give you. So what you do, you pay some premiums. We call them premiums or payments, either per year, mostly per year or per month. And remember, you are so many. So when you give your 30,000 per year or per month, and you have so many people who are doing that, you can imagine the amount of cash that insurance company has. Then out of all those people who are paying that insurance premiums, very few, for example, if it is motor vehicles, very few motor vehicles will get accidents. So the rest is a profit to them because they have taken that risk. You can imagine the motor vehicles when they are paying insurance premiums. You can imagine the number of motor vehicles you have in this country. Even if we have different insurance companies, you can imagine the number of motor vehicles if they are paying premiums per year or per month or after 3 months, then the number of accidents that actually happen compared to those number of motor vehicles, the number of accidents are very minimal. They are very minimal. They are very low. So even if people, those few accidents, those motor vehicles, those owners claim, the insurance company is still left with a lot of money, So that is generally what happens in insurance company. People pay premiums. Now from those payments or from those premiums, the insurance company can invest. Then in case of something, then the policyholder or those people who have paid premiums can claim. and very few claim, very few percentage. If, for example, you have 100 motor vehicles, you can, I don't think it can go even more than 10% in a year of the claims. Then the rest is invested and it becomes a profit of the company. So we are told that insurance companies, they employ portfolio managers who invest the funds that result from pulling the premiums of their customers. So they get a lot of money together because every person is paying some premiums. So they get per month they get millions and millions of money. So what do they do with that money? They invest. They don't just keep that money in a bank. No, they invest that money. They can buy shares. They can buy bonds. They can buy bills. They can even do some residential construction just to invest that money and get a return. That return mostly is pure profit to those insurance companies. So we are told that even like mutual funds, insurance companies tend to purchase securities in large blocks, and they typically have a large stake in several firms. Because of that, in those investments. So the roles they are just highlighted there. They provide cover for business risk. That is the major role that they play. They accumulate large sums of money from premium and this act as a long-term source of finance. So the pooling of money from those premiums that are paid to them. If in case policyholders need or any other party need money in future, they can access that money. In an insurance firm is one that plays the middleman role between policyholders and insurance firms. We find that we have some insurance firms or insurance brokerage firms. They are not the actual insurance companies, but they act as brokers between policyholders and the actual insurance companies. And remember, even those insurance companies, so that's why in Kenya we have a company that is called Kenya Insurance. What Kenya does, it insures other insurance companies. So you have the normal insurance companies, the Britam, etc. Now they need to be reinsured. They are insured by Kenya Insurance Company. So Kenya Insurance Company insures the insurance companies. Then another one is facilitates exchange of securities. We have said that they buy securities, they can buy shares, they can buy bills, they can buy bonds at Nairobi Stock Exchange on behalf of policy holders. We have now other minor institutions, investment companies. We are told they are firms that don't trade in goods and services, but they invest on a speculative motive. In order to get profit, they can invest in securities. So they don't engage in any other goods and services. They are just there for speculative. Speculative means you find that when you say you are speculating, you are saying maybe you from your analysis you have observed that maybe equity bank shares may be reducing in price in future because of one reason or another. So if you have those shares, you sell, or you wait until those prices are low so that you can buy. Then you expect maybe in the future the prices is going to increase or the price is going to increase, you sell. So speculative are those analyses that investors do because of some analysis they have done maybe, or some information that is in the market maybe, and that can influence their behavior in the market. They can influence their behavior in the market. Maybe you have gone to an area, you have had information that there will be a road that will be constructed there. So as a residential or a real estate investor, you buy some land, you are within that area, expecting that the price of that land in future is going to increase because there is a road that is being constructed in that area. That is what I mean by speculating. So investment companies, they're just like the normal banks, the normal insurance company that we know, they all do those functions together. Even if you go to some commercial banks, you find that they still have insurance services. So investment banks and brokerage houses, so brokers, there are so many, mostly because of buying of shares at Nairobi Stock Exchange, I will not talk. We're not going to dwell so much there. Now let's go to the next one: microfinance institutions. So microfinance institution is an upcoming. It is nowadays very common when you talk about microfinance institutions because of the circles, etc. The merry-go-round, all of them are microfinance institutions, and they play a very critical role in the economy. Nowadays, people even go prefer circles than banks. But you find that when those circles started as circles, they end up becoming banks. So we are told that they refer to provision of financial services to low-income clients, including consumer and self-employed. And it also refers to the movement that envisions a world in which as many poor and nearly poor households as possible have permanent access to an appropriate range of high-quality financial services, including not just credit, but also savings, insurance, and fund transfer. So microfinance institutions or the circles, mostly they came as a result of the high cost of borrowing in commercial banks. It is very expensive to borrow in commercial banks, very expensive. So because now poor people could not afford loans from commercial banks, so SACCOs now are the option because SACCOs you own, you come together, you contribute money maybe per month, per year. If you need a loan, if you need some money, another person can guarantee you, you can be able to get that loan and you pay at a very low interest rate. So they came as a result of the high cost of finance in commercial banks. So we are told that a microfinance institution is an organization that provides small loans. These transformed into microfinance institutions that have proved that the poor are bankable. So mostly those the original microfinance that are very well known in Kenya, or they were known in Kenya at the beginning. We have the Faulu Kenya Special. Faulu is a very known microfinance institution, although nowadays it is having some challenges. But it is one of those circles that started. It's a circle. They started growing, and now they advanced to some level of banks. So challenges to microfinance institutions we have there. Traditional banks have not provided funds to clients with little or no cash income. Poor people fall below break-even point. That is, banks lose money on providing loans or in any transaction they make. So some of the clear challenges poor people do not have collateral. So that is one of the challenges that banks are having. Because of a bank, you need a security or a collateral. Before you are given a loan, you need a title deed, for example, you need loan book. So that was becoming a challenge to those people who don't have those things. So that's why microfinance institutions had to come. So that's why we have the importance of microfinance. They provide financial services to self-employed and low-income earners. They are major financiers of small-scale business. They provide their loans with an affordable rate, supervise or inspect the business against which financial services is provided. Therefore, they are acting as an impetus to having more people in the economic venture into business. So they act as supervisors. They give advice so that in case they are giving you a loan to start up a business, they are sure that that business can pick. So mostly those are the financial institutions that you're going to come across, but you're going to realize there is a very major financial institution that I have not included in our notes. That is the Central Bank of Kenya. So Central Bank of Kenya is a financial institution that I have not included there, and it is something that I wanted you to. Yes, I have not included that. It is a financial institution of roles that I wanted to do as an assignment. So immediately after this, I'm going to add a section where you are going to describe the roles of central bank. In our case, Central Bank of Kenya. It is a very, very important institution in the country. There is no way we can work without central bank. Central bank regulates how the economy behaves. I can tell you there are people who sit at central bank and they decide people who have money and those people who need not to have money. There is no way an economy can be in such a way that everyone has money. So do not expect that even in 1,000 years to come, an economy must operate in a way that there are those people who have money and there are those people who don't have money. And that's why you can see in developed countries, like for example US, because most of the locals have money, such economies need people from outside. They need people from Africa, they need people from Middle East to go to their country so that they can balance the economy. Because if everyone has money, I will not be teaching because I have money. So there will be no doctors because doctors will have money. There will be no construction workers because everyone has money who is going to do all those roles. So the economy is set in a way that everyone is not satisfied in one way or another. Everyone need money, in short. But again, we must make sure there are those people who have excess funds. Because if you don't have those people who have excess funds, the constructions that maybe, for example, that we see, big investments that are made, the big hotels that are constructed, who are going to construct those hotels if you don't have those people who have excess money? So that is something that is we should live with. It is a choice now. Do we belong to that sector or to those group of people who have excess funds, or now the middle class, or those people who don't have money? But the economy must have those three categories. The upper class, those who have excess funds, the middle class, and now the poor. There is no way an economy can be in a way that all of us are above middle class, or all of us are poor, or all of us have excess funds. Those people in central bank must make sure that that happens so that the economy does not collapse. In case I have money, you have money, you could not see any reason for you attending this class. So most likely, Zitec will not be there. I will not be there. So the economy automatically collapses. So that's why we must make sure there are those people who have money, they have the middle class, and we have the poor. But now it is a choice. It is your choice now to decide which group you want to belong to. But there must be those groups. So I want you to do that immediately after this. I'm going to add a section for that. You describe the roles of central bank. It's a very, very major player of the economy. And even if you know where central bank is located, I believe you know, in Nairobi CBD, if you know where that building is located, even by just looking at that building from outside, you can tell that is a very strong building. Central Bank building and KRA building, that is the KRA towers, they are among the few buildings in Kenya that are constructed to withstand any kind of earthquake. They cannot just collapse because of another peak. They are strongly constructed. They are very among very few buildings constructed in that way, because you cannot imagine a situation where central bank as an institution collapses and everything collapses with it, because they are very important when it comes to the economy. So please make sure you do that. Then the next, then you have the Capital Market Authority. So when it comes to Capital Market Authority, we have the Nairobi Stock Exchange, NSE. And I need you to do more research on Nairobi Stock Exchange. If you want to buy shares of a company, you can always, the trading of shares is done at Nairobi Stock Exchange. If you want to buy treasury bills, if you want to buy treasury bonds, you can access them in Nairobi Stock Exchange market. If you want to buy maybe to exchange currencies, international currencies, stock exchange market, Nairobi market, I will need you to do more research on that market. Now, who controls that market? Who controls the Nairobi Stock Exchange market? It is now Capital Market Authority. So Capital Market Authority is the authority that oversees all the operations of Nairobi Stock Exchange market, the trading of shares, etc. So there is a history of CMA when it was established, etc., etc. But I need you to mostly concentrate on the roles on the laws. So we are told they have the responsibility of licensing at the regulated stockbrokers. So if you want to do business at the Nairobi Stock Exchange as a broker, you must be licensed by CMA. It is involved in the process of listing of new companies. What we mean by that is, if you want your shares of a company to be traded at the Nairobi Stock Exchange market, you must go through a process that is known as listing. So the listing is done by capital market authorities. It's a very big institution in the economy. Then another one is it is involved in the making of policies that would enhance the development of the capital market. So in case the government wants to make some policies on capital market or stock exchange market, CMA is very much involved. Then it acts as a watchdog for shareholders of listed companies. When your company is listed, meaning that your shares can be traded in the Nairobi Stock Exchange market. The CMA is kind of become watchdog of how that business or that company is run. So there is no way that company can misbehave if CMA is there. So CMA oversees the operations of those companies. If at all your shares are in Nairobi Stock Exchange market, know that all your operations are observed by CMA because CMA are there to protect those people who have bought shares of those companies. Then it assists in the development of new securities. In case we need to come up with new securities, CMA is very much involved in development of such securities. It acts as a government advisor through the Ministry of Finance. So in case the government needs to be advised on maybe something or a policy involving capital market or stock exchange market, they advise the government. They remove bottleneck and create awareness for investment in long-term securities. So they educate even individuals and businesses on the various securities that are there, how to buy benefits. They serve as efficient bridge between the public and private sector. Because remember, those companies are private sector, and now we have the government here. Because CMA is controlled by government, it is a government institution. So they become like a bridge and they play. So the government can oversee companies how they are doing so that they don't do something that is against the wishes of shareholders or stockholders. They remove barriers on security transfer, etc. So there are so many roles there. Those are the roles that I needed to understand of CMA in the development of the country or the economy. But you have some other rules down there when it comes to implementing in determination of share prices. Remember, when your company is listed in Nairobi Stock Exchange, meaning your shares can be traded at Nairobi Stock Exchange. If it is, for example, Equity Bank, those shares have a price. Unapata the price of maybe Safaricom, for example, today was 15 per share. Tomorrow it will be 15.50. Another day inaweza chini 14. So how do those prices come up? How do they come up with those prices? Prices are determined by what? What are the prices? What happens when the price goes up or down? It is as a result of demand and supply. When people demand, for example, prices of Safaricom, when so many people demand prices of Safaricom, the prices are going to go up. When a few people demand those prices are going to go down. Another factor that can affect the price is now maybe information about the company. Maybe, for example, nowadays we have rumors that Taskis is not doing so well. There is some management problems as they are unable to pay creditors on time. So such information will affect the prices in the market. If there is a negative information about the company, prices are likely to go down. If there is a positive information about the company, prices are likely to go up. So CMA is just overseas. Is the mind. Then we are told that the prices of some people demand more of a share, the price increase. Then the CMA may advise the company on the issue price of new securities. They can just give advice but not determine. If they can still allow investors if they feel that the issue price of certain securities is not in their interest. They can still talk to shareholders or investors that a certain price may not be serving the interest that they are having. So note that CMA does not price, just oversee, just regulate the operations of stock. So I think that this subtopic here, financial institutions and intermediaries, mostly know about the roles of commercial banks, know about the roles of insurance company, know about at least the role of microfinance institutions, then roles of capital market authority. And then from our assignment, the roles of Central Bank of Kenya. So I'm going to stop at that. In case you have a question, please, I'm waiting. This is your time. In case you have a question, clarification needed. If you have a question, please. Any question, please? I'm waiting. So, Daisy Kenyari, if you go and search Kenya, So they say, hope you have gotten that. It is Kenya Insurance Company. It is the major one, although we have others that are not major, they are minor. But Kenya is the major insurance company. If there is no other question, please allow me to end the meeting or this class. In the next few minutes, I'm going to share some resources of our next topic. It is a mathematical topic, cost of capital. I have some videos that I've prepared. Download those notes and you download those videos. You listen to those videos, you make notes from them. In our next class on Tuesday, we are going to use them. In those videos, I've explained the various examples. I have done those examples here and there. So I even expect by next week you are going to have understood much in that topic. So next week will just be confirming was there a problem somewhere. So that is it for today. Have a nice week.